Out of thousands of dividend-paying companies in the world, only 5 have paid safe dividends for over 100 years and yield above 4% today. These businesses have provided dependable income through world wars, recessions, countless rate cycles, and today we're going to take a closer look at each one of them to see which could still deserve a place in an income portfolio. Welcome to the Simply Safe Dividends channel. I'm Brian Bollinger. Let's start by reviewing one of the oldest and highest yielding names on the list. First up is General Mills, ticker GIS, with a 5.2% dividend yield. I'll be using our website, Simply Safe Dividends, to analyze General Mills. You can use our site to track your dividend portfolio, find income ideas. It's free to try, no credit card required or anything like that. I'll leave a link in the description below. All right, here's General Mills' stock page. We can see that 5.2% dividend yield is the highest in a very long time. In fact, the yield has nearly doubled compared to just over a year ago, reflecting the big drop we've seen in General Mills' stock price here, this gray line. Investors are worried about growth. Consumers have become a lot more selective with what they're buying, and a lot of the big price hikes on food that went through during the pandemic are now starting to bite the companies like General Mills, as consumers look to trade down to cheaper private label goods and are just being a lot more selective with what they're choosing to spend their money on. So we can see sales have started to decline coming off of that pandemic boom. Organic sales were down about 2% last year. General Mills is expecting them to be flat in the year ahead and slowly get back to its 2 to 3% long-term target. Achieving even moderate growth is no guarantee. General Mills has over 100 brands, and its largest franchises are kind of in that crosshairs of being center store, shelf-stable, highly processed goods. So you can think of brands like Betty Crocker, various types of cereals like Cinnamon Toast Crunch. Of course, there's the refrigerated and frozen doughs from Pillsbury, Progresso Soup. A lot of product categories that are not really aligned with consumers seeking out fresher, healthier options, higher in protein, and less processing. So there are a few bright spots here. You have the Blue Buffalo Pet Foods, which has done really well since General Mills bought that almost a decade ago now, and Annie's, which has a line of organic products like mac and cheese. But overall, General Mills does have some work to keep reshaping its portfolio, reformulating its snacks and cereals to try and make them more on trend. Now, the company has been investing heavily in its portfolio, which is good to drive this change. Analysts think that earnings and free cash flow are bottoming this year and will return to slight growth in the years ahead. That would be good news because General Mills' payout ratios have been increasing to about 70%. That's up from 50% just a few years ago. Until that payout ratio kind of comes back towards that 50-55% level, I think the dividend will only continue to grow at token penny raise like we've seen the last 2 years, so kind of resulting in that 1 to 2% annual growth. Now, the dividend has been paid safely every year since 1898. Hard to believe, but that's been almost 130 years. I think General Mills will maintain its dividend. I think the balance sheet is in a reasonably good place with the BBB credit rating. I think the biggest wild card is whether the firm does return to growth with its portfolio. If it doesn't, then management may be tempted to shake things up, maybe make a big divestiture or want more financial flexibility to make an acquisition. So that's something to pay attention to. But for now, food is just a really hated space. There's not much growth in a market that's loving any type of growth and momentum name, especially AI plays. I don't think the consumer headwinds will last forever, but I think they could persist for a while longer. General Mills is a stock that I've owned for about a decade in one of our 3 model portfolios here. And I'm going to keep holding for now. I'm not expecting a whole lot in the near term, but I think this is a business that generates good cash and will be around for a very long time. Its brands are in over 95% of U.S. households, and that type of distribution is hard to disrupt. So I'm sticking with General Mills, and let's take a look at the next stock. Up next is Chevron, ticker CVX, with a 4.3% yield. Chevron was started in 1879 when an oil field near Los Angeles was discovered and yielded 25 barrels of oil per day. Today, Chevron is one of the largest integrated energy companies in the world, producing over 3 million oil equivalent barrels daily. It has upstream production businesses, it has midstream pipelines, downstream lubricants, chemicals. This integrated model helps keep Chevron's costs low and smooths out its cash flow. If oil and gas prices are down, for example, a lot of these downstream businesses will enjoy higher margins. Now, Chevron has paid a safe dividend for over 110 years. That dividend has been increased every year for 37 straight years, including about a 5% raise in January of 2025. I think the dividend remains a really solid bet. We give Chevron a very safe dividend safety score of 90. In part, that reflects the company's strong financial foundation. So Chevron has a AA- credit rating, which is exceptionally strong. The business maintains low debt levels intentionally. We can see down here the net debt to capital ratio is very low. About 15% of Chevron's total capital base is from debt. And that allows Chevron to weather the different storms in the energy industry that are always hard to predict. But there will be times when free cash flow goes to zero or even flips negative, and Chevron can lean on its balance sheet to borrow money to keep the dividend going until times recover and cash flow is restored. Now, the best time to buy a business like this is when Warren Buffett did it back in 2020. When investors are panicked about short-term oil and gas prices, the stock tends to tank. You can see the stock price here fell significantly during the pandemic. But over the long run, Chevron's dividend has been a pretty good indicator of the stock's reasonable value. This blue band here is the price you would expect Chevron to trade at if it was 10% above or below its 5-year average dividend yield. A lot of these mature blue chip companies will trade at persistent valuation multiples over time, and Chevron's dividend has been so stable it does a good job of reflecting the company's earnings power. And the few times you've had a chance to buy the stock when it was well below that expected price band would have been wonderful times to invest, as we've seen it quickly recover back into that area where it sits today. So Chevron is a pretty good idea if you are a conservative income investor who is optimistic about fossil fuels remaining a core component of the world's energy mix going forward. Next is UGI with a 4.5% dividend yield. UGI was America's first public utility holding company when it was founded back in 1882. It paid its first dividend just 3 years later in 1885 and has maintained safe dividends for the 140 plus years that have followed, giving it one of the most remarkable dividend track records in the stock market, despite being a somewhat lesser known company. Now, unlike many of its peers, UGI is not a pure play regulated utility company. Distributing propane is a non-regulated business and accounts for roughly a third of UGI's earnings, with operations in both America under the AmeriGas brand and also abroad in Europe. The propane business is much more volatile because most of the demand for propane comes from heating homes in the winter, so weather can play a big role in a given year. And propane demand is also just more linked to the economy. There's no minimum volume guarantees or anything like that. So the propane trucks that go out can play a big role in UGI's profits any given year. This causes the stock to trade at a pretty notable discount to the broader utility sector, which trades at about 20 times forward earnings. UGI is closer to just 11 times. So the stock is given a pretty big discount for having that propane business and just a more complicated business overall. That led management in 2023 to initiate a strategic review for the propane business. They were considering spinning it off or possibly selling it. It was not performing well. It was facing higher transportation costs from a truck driver shortage, unfavorable winter weather conditions. Management ultimately decided in 2024 to hold on to this business to try and improve it themselves. They weren't happy with the offers they were given for it, which looks to be a wise decision. The stock has bounced back nicely from then, and the company's payout ratio, targeted between 45 and 55%, is in a good spot as well. UGI has also made good progress paying down debt to get its leverage where it wants it. The business is small enough where it doesn't have a credit rating from S&P, but leverage is at a reasonable level now. But all of that did cause the dividend to be frozen for several years. Management is hoping to return to dividend growth in 2027 at a 4% annual clip, which would be a little bit slower than in the past, but not a bad combination with a starting yield of 4.5%. However, we think UGI ultimately does want to get out of propane. We give the company a borderline safe dividend safety score of 60 until we have more clarity on that front. UGI could continue its dividend without the propane earnings. That payout ratio is well below the 60 to 70% level that pure play utilities have. Even without the propane business, it would still be in a healthy range. So I think UGI could and probably will keep the dividend, but we would just like to see a little clarity on the propane front. Until then, dividend growth investors are probably going to be more interested in other utility names that offer a similar starting yield with current growth in that dividend and none of the uncertainties caused by having a pretty big non-regulated business like propane. Next up is Stanley Black & Decker, ticker SWK, with a 5% dividend yield. Stanley Black & Decker was founded back in 1843 as a small shop making door bolts and other hardware. It is now the world's largest tool maker with hundreds of thousands of products, everything from drills and wrenches to fasteners, medical cabinets, lawnmowers, many well-known brands that have been around for decades like DeWalt and Craftsman. But many of Stanley Black & Decker's end markets are sensitive to interest rates. The company has about 20% of its sales tied to existing home repair and DIY projects, another 24% tied to new home construction, some ties to the automotive space here, commercial construction. So, as you can imagine, the jump in interest rates in recent years has really hurt the stock. Coming out of the pandemic when demand boomed for many of its products, with many consumers being at home more, taking on projects, the company ran into some inventory problems, and then high interest rates have resulted in lower volumes in a lot of those end markets. That has caused Stanley Black & Decker's credit rating to be downgraded earlier this month by S&P from A- to BBB+. The main drivers, again, are those lower volumes in outdoor and DIY categories, but also tariff-related cost pressures. So we published a note on Stanley Black & Decker back in April when a lot of this was dominating the headlines. And in the U.S., which is its biggest market, about 60% of the products sold there are made or sourced from overseas, with China and Mexico being big supply sources. So the tariffs have kind of bit into Stanley's profits, which were already under pressure from lower volume in some of its end markets. And that has caused earnings and free cash flow to take a big hit and be slow to recover, putting Stanley's payout ratios pretty far above management's 30% target level. Now, the company is doing a lot of self-help efforts, taking out costs in the business, trying to streamline its inventory, find new sources of supply and new vendors, all of that to defend this impressive dividend track record, safe payouts for nearly 150 years, and Stanley is a dividend king with 57 straight years of dividend increases, including kind of a token 1% raise in July earlier this year. Now, I think Stanley Black & Decker can weather this storm. We still give the company a safe dividend safety score of 70, but it's a situation that needs to be closely watched. If there were to be a recession, which would further depress demand in some of those markets like automotive and construction, then Stanley would take longer to kind of get its payout ratio back in line where it wants, and it would face more pressure on both its credit rating and leverage metrics. That could put the company in a tougher spot, having to decide what to do, how long it was willing to wait as pressure builds while paying out a pretty big dividend. At the end of the day, I kind of prefer to avoid turnaround type situations like Stanley Black & Decker. I'd rather focus on other companies that are seeing stronger growth and have stronger balance sheets as well. But it's a situation we'll keep watching, and if something does change, we'll write up a note explaining that to our members who own Stanley in their portfolios. Last but not least is the Bank of Nova Scotia, commonly known as Scotiabank, ticker BNS, with a 4.9% dividend yield. Scotiabank is one of Canada's big banks. It gets about half of its profits from that country, another 10% from America, 11% from Mexico. It's focusing more on these regions, including an investment in KeyCorp in America, while reducing its footprint in Latin American markets, which can have more surprises. It's a developing region, so loan losses can be higher, just a riskier area for banking, so it's trying to improve its risk profile with that slow shift. Its operations are otherwise pretty standard. You can see that basic Canadian and international banking activities generate roughly 70% of the bank's profits. Think of basic lending operations like mortgages, or fee-based businesses like credit cards. Wealth management and other fee-based business is 15%. And then finally, global banking and markets is around 16% of Scotiabank's earnings. Now, the company has the longest track record of safe dividends on this video, 192 years. Dividend growth has been pretty steady over the years as well. Looks like it was frozen during the financial crisis and then also during the pandemic for a year, but kind of averaging 4 to 5% annual dividend growth over the long run. Now, Canada itself has not had a banking crisis since 1840, which helps explain this remarkable dividend track record. Up in Canada, it's different than here in America, where the 6 largest banks in Canada have over 90% market share. This puts them in a great position to be able to offer their customers a lot of different services. It also, that scale helps keep their deposit costs down and allows them to make cost-effective loans. Banks are also required to hold more loans on their books, including mortgages, instead of selling them off to third parties. So the lending practices tend to be a bit more conservative as well. BNS has a pretty solid financial profile. Its payout ratio has been coming down since a few loan hiccups in Latin America. Sits near 50-60%, pretty reasonable level. The bank also maintains a very strong credit rating of A+, reflecting its capital levels. Banks are required by regulators to set aside excess capital to hold for downturns to make sure they can remain solvent, and BNS holds above and beyond the limit that regulators require. So overall, it's a very reliable bank. I don't really own any bank stocks in my portfolio, though, because I find them to be kind of complicated investments. It's hard to really know what's in the loan books. They're also very cyclical businesses as well. And it's a very competitive marketplace. BNS, despite operating in an industry with pretty favorable dynamics, its stock price hasn't really gone anywhere for 20 years. And it does take pretty big dips when there's panic about the economy. That's the best time to buy a bank stock, whereas now it's done pretty well over the last year, bouncing back. So banks aren't really fully for me, but they might be of interest to you. And if you're going to go into that space, I think sticking with a proven giant like this that's well capitalized and is able to spread risk across a lot of different businesses is a pretty wise move to make. If you're looking for more income ideas for your portfolio, I recommend registering for a free trial of Simply Safe Dividends. I'll leave a link in the description below. It takes less than a minute and there's no credit card required. You'll have instant access to a few different places on our site that can help you get ideas, like our newsletter. So every quarter we hand pick 8 ideas to share with our members, including these analyst write-ups that basically pitch you on why the stock looks interesting to us. So right at your fingertips, you'll have an idea you can consider that's actionable for your own portfolio. We also have a stock screener and a closed-end fund screener. You can screen on dozens of different filters, including our dividend safety score, everything from credit ratings, dividend taxation, dividend growth rates, payout ratios. It's all available and allows you to really find an idea that aligns really well with your risk tolerance and personal preferences. So that's a place that I go to most weeks to just try and find new ideas for my own portfolio and things that our members might be interested in. We also have idea lists, including a list of hand-picked high-yield stocks. You can find the aristocrats and dividend kings here for easy filtering. We also publish research regularly on companies as their dividends change and as their outlook for dividend safety changes as well. So this is really helpful to gain confidence in companies that might be in your portfolio. You'll get an email alert whenever we publish research, or a way to also find ideas as conditions change, with it all tied into a focus again on dividend safety. So our site also has a portfolio tracker. You can track unlimited portfolios. You'll get an immediate look at the dividend safety of your holdings. You can upload your portfolio, manually enter it, or sync your brokerage account. You'll see your dividend growth rate, how diversified you are, everything you need really to stay on top of your income stream and make sure you're also staying between the guardrails that you want to keep your retirement on track. The holdings table in this tool is awesome. You can again pick from a few dozen different column options to see exactly what you want on your holdings. You can move around the order to get that view personalized, and it's all right there, updated in near real time, and it's free to try. So give it a check if you're interested in this. And thank you again for watching today's video. I really appreciate it, and I hope to catch you next time.